Ken Orange Theory Trader back with you with another video just talking about the risk management battle, scaling up versus staying static. So let's get into it. So here's a clean Ken Orange Theory trade. Same chart that we all can see and look at. But let's see how two traders manage their risk. So we have two traders, trader one and trader two. So trader one, he trades very simply. He takes one entry and he goes all in on his risk every single time. Now, when I say all in, I'm not saying he's risking his whole account. I'm saying that if he wants to risk 50 bucks, he's going to set his risk and his position size so that it's 50 bucks and that's it. And he has a 1 to 3 risk to reward ratio. So he's risking 50 bucks to make 150 bucks and that's it. Trader 2, he takes multiple entries. He manages his positions. And what he does is that he doesn't go all in. Okay. He may still end up risking 50 bucks total, but he's going to start small first. He's going to dip his toe in the water before he decides to add more size to this position. All right, so let's see how the trade plays out. So in this case, it's a winner. So trader one, he aims for 1 to 3. He has a stop loss and take profit of about 10 pips and 30 pips to take profit. He risks 50. He gets 150 profit. Done deal. That's it. Okay, he sets the trade and he just walks away. He's done. It's over. The trade worked out. He won. Now trader two, his first entry was worth 10 bucks. So it wasn't as big. His position size was not as big as the first trader. As the trade starts to move into his favor, he adds on green candle closes that look strong to him. Okay, so he adds in total 5 positions. So while he aims for the same 1 to 3 on his base position, the second one, third, fourth, and fifth, okay, do not get the same risk to reward consideration. Okay, so the first one, and I think I only included 4 in here. I meant to add another one, but I did not. Forgive me for that. Okay, I apologize. Okay, but let's just say though that his first entry makes about 30 bucks, the second one 30, third one 25, the fourth one 23, and the fifth one 20 bucks. All right. So that would have been 1 to 2. Risk 10, make 20. Okay. So his total was 128. Okay, after everything closed out. Same price action as we can see. Okay, 1 and 2. All right, so same price action, but different approaches to risk. So here are the numbers though. Trader one had a potential downside of 50 bucks, potential upside of 150 bucks. Trader two had a potential downside of 10 bucks to start, okay, before he added another position. What is potential upside? I just gave a general range of between 100 and 150. Okay, we really don't know because we don't know how far price is going to go. So there are advantages and pitfalls to each method. Trader one does have cleaner risk. Okay, he knows that, hey, look, I'm risking 50 to get 150 and I'm out. I'm done. Okay, but at the same time, he's opening himself up to bigger losses. And if he gets on a losing streak, which is inevitable, that could cause major damage depending on how big his account is. Now, obviously, if he has $1,000 and he risks 50, that's not going to do a lot. But if he has a $500 account and he's risking 50 bucks per trade, there's only so many losses you could take doing that before you start to say, hold on, wait a minute. Okay, maybe I need to scale things down. But at the same time, he does have to spend less time in front of the chart. Once he knows his risk and has measured everything out, he takes the entry and he's done. Okay. And again, this method, Trader One's method, is better for bigger accounts. Trader Two, on the other hand, he can risk more, but at the same time, his risk gets more unclear as his positions are added. He doesn't really know where he's going to end up when he hits the take profit button, okay, or even the close all positions button because he's adding into it. But at the same time, though, if he takes a loss, his losses are minimal because let's say this trade was a loser from the first entry right here. Let's say price just went down. This trader only loses 10 bucks, trader 2. Trader 1 lost 50. Which sounds better to you? Losing 10 bucks on a trade or losing 50? Okay? Don't be so focused on the upside that you forget about the downside. Okay? Now, as well, though, trader 1, in order to make sure his losses are small, he has to spend more time in front of the chart. He has to watch price go tick by tick. This is a 5-minute chart, but he's watching this entry. He's watching this one. He gets into this one, and but he's watching for these additional add-ons. This takes time. This does not. Okay, he could have been in this trade in about, what, 5, 10, 15 minutes or so. Okay, and then he's done, right? This one, you're talking about what, 5, 10, 15, 20, 25, 30, 35, 40, 45, 50, 55, 60. You're over an hour now. Obviously, you got to be in front of the chart. You get the point. I don't have to overstate the obvious. All right. So there is a time effort for that. But at the same time, risking smaller amounts per entry can be better for smaller accounts. So, in conclusion, you have to decide what's best for you. I only wanted to put this out to show you the main two ways that people trade, but don't be so locked into one way of trading that you think your way is the only way of managing risk. The result at the end of the day is still profit, and there's more to one way to financial heaven, as Warren Buffett says. Okay. Now, the bigger your account, the less risk you should be taking, but stick to your goals and don't be greedy. What do I mean by that? Let's say if you just want to make $1,000 a day, all right, or you know what? Let's say 500. Well, no, we'll say 1,000. It's just your dream to make $1,000 a day. How much would you have to? How much would you be willing to risk to get there? Okay, would you be willing to scale in to get to that thousand, or do you just want to do one and done? I can tell you right now, for a one and done, for 1 to 3, you're gonna have to take a pretty big risk to hit 1,000. Because let's remember this too: for this profit, even though he risked 50 to make 150, this person here risked 10 to start and got 128. That's pretty darn close to the same 150 that this guy made. So he did have to put in more time, but because he actively managed his position, his worst case scenario was much better than this person. And that's just a non-negotiable. Losing 10 is always better than losing 50. However, he had to put the time in to do so. So you have to weigh it out. Okay, is my point. You have to weigh it out, and depending on your situation, you just do what's best for you. But it's always managing risks is what's going to get you paid, not quote unquote trading. Okay. And some days you may want to flip flop between the two. Okay. Maybe one day you want to scale in, another day you say, hey, I don't have a lot of time. I'll just throw one position on, but make it still worth my while so that if my take profit gets hit, then it'll be worth it. But if my stop loss gets hit, the hit will be small enough that my account doesn't have to get another deposit, or I blow my account if you're using a prop firm. Okay. But either way, okay, so trader one and trader two. Of course, there's more benefits and drawbacks to each approach, but it's your business. So you run it as you see fit. So I appreciate your time and attention. Thank you for watching and have a great rest of your day.